You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. There was more choppy trading this week as investors remained focused on earnings, commodities, the debt crisis in Europe, and global economic growth. Weak reports on housing starts and permits and a drop in home resales added to investor concern. The Fed released minutes of its April meeting, which showed its members divided on whether to hike interest rates this year. Weekly jobless claims brought some positive news on the jobs front, but all in all, investors seem to be having some difficulty grabbing onto any type of strong trend in the market or in the economy. So with that, we'll bring in Steve Reitmeister and talk a little bit about the economy first, Steve. Do you think, as far as the economy is concerned, I mean, we're coming up to June, are we in for another period like early last summer, slow growth in the economy?
Yeah. Well, I think it's all a matter of expectations. I think there was far too many folks who had the general, the coming out of recession kind of expectation of 4% plus growth, and that's just not going to evolve here. So for me, I was always in the muddle through kind of camp. You know, we have a lot of baggage that we got to clear up with. And so I think that the growth is going to be in the 2 to 3% range for a long time. And so sometimes it might slip down like it did last quarter, like a 1.8, okay, just a little bit under. And I think sometimes it might peek its head right above it. But that's the general area that we're playing. And that is a healthy enough area in which over the long haul to raise corporate earnings, to lower the unemployment rate, and to create a little more of a wealth effect in this nation. It's just not going to be gangbusters. And so too often when we do slip down to that 1.8 kind of range, people are going to be wondering, oh boy, are we going back into recession? I don't think the answer is yes. It's just no. It's just slow, muddle through growth and deal with it. Okay.
Just 2 weeks ago, stocks were at their highest levels in nearly 3 years. Given where they're at today and with all the volatility thrown in addition to all of everything else, are you nervous about the market here?
I'm not nervous about it, but I do expect it to be a choppy, volatile summer, and that's what I've been talking about. I almost want to scratch the word volatility from my vocabulary because I'm like using it every day. I just want a new word for it, you know, with choppy, all over the place. And what you said in your open was that our investors are having a hard time grabbing onto the trend. Now, the long-term trend is clear. We've been rebounding for 2 years. We have economic rebound, we have earnings rebound, we have a stock rebound. That trend is still in place until proven otherwise. In the short run, where's the market going to run in the short run? I think it's going to be all over the place. Every single report that's going to come out, if it's bad news, the market will go down that day, and if it's good news, the market will go back up. We probably emerge from the summer pretty much where we started, at the end of April, and then we see, here again, is the economy still moving forward? Are earnings still coming up? Is the valuation of stocks reasonable? Is the Fed still accommodative? And so far, I believe it's yes, 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 and yes. That's 4 yeses. And then we should be moving higher. Short term, who the heck knows? Long term, I still think the picture's clearly up.
Okay. Tracy Reineck is our equity strategist. Let's bring you into this conversation here because you've been following what is termed insider buying lately, and you've been talking a lot about it, writing a lot about it, about the importance of insider buying activity on the whole. So tell us why it's a vital topic and something that investors need to pay attention to.
Well, I mean, whenever an insider takes their own money and goes and buys stocks of the company that they work at, it says a lot about what might be going on in that company. Because obviously they can put their money anywhere and they're risking it by putting it into something that they know a lot about. And so something pretty good is probably going on there if they're, putting their own cash into it. The interesting thing is, playing on what Steve said, is that there's been more insider selling than buying in the last couple of weeks. So that, I don't know what kind of signal that sends, but those people who are buying, I think it's sending even a bigger signal because there's less of those. And you're kind of seeing them buying in certain areas that are out of favor to some extent in the overall markets. Like you see them in like commodities or manufacturing that some people are starting to turn away from in the last couple of weeks. So I think that's sending a really positive signal because they're not seeing the downturn in there because they're going in and buying up the shares.
If I could just chime in for a second. You also have to remember that most of these CEOs and directors, they already have a lot of the stock of the company.
Right.
So when they reach into their own pockets and they buy extra shares,
Right.
why are they willing to take the extra risk? Because they believe the extra reward is laying out there for them.
Okay, so I was going to ask about that. By insiders, we're talking about the higher-ups in management, corporate management.
Right.
Okay, so I understand that not all insider buys are equal, but what do you look for to find stocks that are likely to go up because of this insider trend?
Well, you do look for some of these things like we were just saying, where they're in industries that still have the good fundamentals, they still have rising earnings. Maybe the valuation is still really good, and usually that's what I've been seeing is that the CEOs and the directors are buying where the valuation is still really good. Like they think they're getting a deal, so why wouldn't they buy in? And they're going to cash in here. Mm-hmm. So you still have to look at the fundamentals, and then you combine it with the insider buys.
Okay, some very important stuff for us to pay attention to. More is still ahead. Stay with us. Here is your Bull and Bear Stock of the Week. A large machine manufacturer and an e-commerce company make up this week's Bull and Bear of the Week, and Shiraz Mian, our research director, is here again to give us the details of each one. Now, the machine manufacturer is Caterpillar, CAT, the ticker. We've talked about this one before, have we?
Yes, we must have. Caterpillar is that machine company which gives us a very direct exposure on all the positives that are happening outside of the U.S. There's a bunch that is happening in the U.S. and in the other developed markets as well. But all the growth that's coming out of Asia, Latin America, and all the emerging markets, Caterpillar is a direct play on those markets. Okay. Now, they have, whether you are in the infrastructure, construction, housing, or all those areas where the emerging markets need to spend, Caterpillar has an exposure to it. The company went through some major operating restructuring over the last few years, which really put them in a position to benefit from when the market turned around recently. They also made a very good acquisition recently, Bucyrus, which gives them a direct exposure to the mining equipment company. And once that transaction closes, it gives them a much more broader machinery portfolio, so construction as well as mining.
Yeah.
So overall, a very strong story. They will earn about $7 in earnings in 2011. And in 2015, management is targeting earnings in the $15 to $20 range. And many of the analysts covering this stock consider that target to be relatively on the conservative side. So the trend is very favorable for Caterpillar. And if some of the folks are relatively queasy about picking up a direct emerging market stock in Brazil, India, or China, this could be their play.
Trend is not so good for PetMed Express, though. PETS, the ticker, that's the bear of the week.
That's right. So in addition to all of the issues that we keep talking about consumer and the retail space, PetMed has some company-specific problems to deal with as well. The key problem is, and by the way, they are basically an online pet pharmacy. 2/3 of their sales are of over-the-counter pet medications, 1/3 prescription drugs. Okay. And the competitive landscape in this space has really heated up. So whether they're specialty retailers or big box retailers like Walmart and Target, they are really coming in very strong in this space and making it tougher for specialty players like PetMed to really keep earning those margins and earnings as they have made us used to. So the competitive pressures are forcing them to spend more on promotional material and discount their prices to attract customers. As a result, we are seeing margin pressures. We are seeing fewer newer customers coming through the door, and the average order size is also on the decline. So overall, it's a picture of declining profitability.
Okay, we're going to bring the microscope down on another stock next. And now, Stock Talk, analysis of stocks in the news. Well, Dell logged in record first quarter earnings, but reported that their PC sales slumped during the period. And some analysts say that's a worrisome trend for the computer giant, so we thought we'd take a closer look at the stock of Dell with our equity strategists, Tracy Reinick and Mike Vodka. So, Tracy, we've got a real interesting situation going on here. We've got good earnings came in, record earnings causing the stock to jump to a 52-week high. Yet over the past 5 years, many analysts have just hated on Dell.
Right.
And now, even now, they're still looking for something to not like about the good news.
Right.
But why is this other trend, PC sales down, why is that worrisome, or is it?
Well, it is kind of misleading because you have these headlines about the PC sales going down, and everyone knows there's like the laptops and now the iPad and all this other stuff that's taking some market share and things like that. But they've been transforming their business away from the consumer side, which is what most of us know, to the corporate side, to the enterprise side. And that means the consumer PC sales are down, and those are a lot of desktops because who's buying the desktops anymore? Nobody.
Right.
But on the enterprise side, the PCs and laptops were actually up 7% for this quarter. And that's the bigger side of their business now. And they've also made big inroads in servers, and they're heading more towards the cloud computing. So the story isn't quite as bad as some of these headlines might make out.
Yeah, that's what happened. Sales to businesses were offset by a decline in the consumer segment.
Right.
That's the reflection of that change in business model that you talked about. Mike, what's the momentum on this stock?
Well, kind of echoing what Tracy said before is the market definitely seems to like Dell right now. We've seen some pretty steady upward movement over the last month. This is a 1 month chart we're looking at right now. Shares did gap higher on the nice quarterly results. We hit a new 52-week high at 1696. And below the chart, you see a MACD turnover, the short-term moving average accelerating ahead of the long-term average. So that's another bullish indicator. So the shorter-term picture is looking pretty solid for Dell right now.
So momentum is to the upside for this stock.
Yeah, I wanted to point out one more thing too on a longer-term basis. I've also brought a 2-year chart with me. Is we see a head and shoulders. We're approaching the 2-year high, so the company has some nice momentum on the chart right now.
So what does that mean? We're seeing a head and shoulders. Is that a good thing or a bad thing, Mike?
I'm happy you asked. It's actually a good thing. It's a bullish sign. Yeah, the formation is in play right now, and we're pressuring the 2-year high, so it's a bullish indicator, definitely.
Okay, so Tracy, we had improving profit margins as a result.
That was a big deal.
That was a big deal. Yet the gains being moderated in the stock price because now there's skepticism among the analysts and brokers again as to how this can be sustained going forward.
Right. The profit margins jumped from 19.2 to 23, which is huge. And some of them are like, well, can they keep this going throughout the rest of the year? Some of that will be pressured by the costs of the components, but Dell keeps trying to convince the analysts on the conference call that this is sustainable. And we have a lot of, like Mike said, there is a lot of momentum on the business side and with the share price. They're also doing really great things in Asia. They're really seeing big sales push in India and China, but India is their big market. So there's some good story going on there too.
Yeah, weaker top line growth is what everybody's pointing to right now.
Right.
And those brokers and analysts, they're a pesky bunch.
They are.
In case you were wondering, of the 34 brokers that cover Dell, 16 rate the stock a neutral, 4 maintain sell calls on it, and another 14 analysts rate the shares a buy. So not really a bad picture overall, not as bad as some headlines might suggest.
No, not at all.
All right, thanks for being here with us. We're at the Roundtable coming up next. You're not going to want to miss it. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. The market has been weak and volatile since May began. The question is why and what's next? And we're going to try to find answers to those two questions as well as get top stock picks from our editor-at-large Steve Reitmeister, research director Shiraz Mian, and market technician Kevin Matris, this edition of the Roundtable. So Shiraz, I'm going to start with you, since Steve kind of talked a little bit about this in the beginning of the program. Why are stocks struggling here so much?
It's concerns about the economy. If you would recall, we had a fairly weak first quarter read on the economy, 1.8%. But the market essentially shrugged that off in the belief that the forces driving that slowdown were transitory. Now, what we've been seeing lately is that we are seeing a number of economic reports that are showing or maybe implying that first quarter softness may be creeping into the second quarter as well. So the consumer is hard pressed. We have high fuel prices. The housing is essentially in a double dip already. And even more worrying from my perspective, we saw very soft readings on the Philly Fed and the Empire State surveys. So the manufacturing, which has been a standout performer thus far, if we see softness in that as well, then it really puts question mark on the growth momentum. So it is basically these questions and concerns about the economy's near-term growth momentum that's been weighing on stocks lately.
But those last two indexes, just to follow up a bit, only reflect one region of the country. Do they carry that much weight?
They don't, but we need to see, for example, those indices and those surveys were showing a lot of strength in the preceding months. Now, then we move on to the Chicago PMI and then the national ISM manufacturing, and those are coming up in the next few days.
Yeah.
So if there was weakness in New York and in the Philadelphia area, and we see that, for example, in the Chicago PMI as well, then we may have softness on the manufacturing side.
That's a good point.
Okay. Those reports are very volatile. Okay. Last year, they were both pointed negative for a period of time, or came in very soft and proved to be wrong in the grand scheme of things. And all those reports are still in positive territory, just weaker readings than expected. So when you add all those things up, I mean, it's not that you completely discount them. I would just kind of say, okay, I need more confirmation because they don't have a great track record of reliability, and they still are in positive territory.
But they are enough to add to concerns in the market.
If you're already concerned, if
right.
you're looking for trouble, you're going to find
right.
it. Okay,
That's right.
I'm just saying that I can find it easy to brush off because I'm not that concerned.
Kevin, are you concerned?
I got a slightly different take. I do agree with what they said. I'm not overly concerned with these reports, but I believe that this sell-off is commodity-induced. I see energy pulling back, I see basic materials pulling back, and there are a lot of commodity-related stocks that are seeing pullbacks as well. So it is very realistic to understand why the market is pulling back, but over the long term, this is a positive because lower input costs means more money left over for consumers to spend, more money left over for businesses to profit. I think there is a lot of steam left in the market. I'm looking at this pullback as an opportunity to buy, not as an opportunity to sell.
Okay, that's interesting as well. So based on what you said at the beginning of the show, what you said again just a couple seconds ago, I'm guessing that the Reitmeister Panic Selling Index alarm has not gone off yet.
Well, no, it did go off. The Ryder Panic Selling Index, my
Very
patented,
accurate, by the way,
patent
very
pending,
accurate.
right, is that I'm supposed to be like a more seasoned investor, but but there's a time like when the market gets pushed too low and it just doesn't seem rational. I'm like starting to think, should I be selling? If I usually wait a day or two after that goes off, the market bounces. Well, that was going off earlier in the week, and indeed, on Tuesday during the day, the market bounced, and then we had 2 other days in the plus column because I just felt it was oversold conditions. Okay. So, but unfortunately, I think the Reitmeister Panic Selling Index is going to go off several times during the summer, and it's going to bounce back up, and that's just going to be the nature of this summer as there is this kind of question mark. Prove to me that economic growth is going to stay at 1.8% or better and not sliding back towards that 0 or worse mark.
That's right.
And that's what the struggle is going to be for right now. But I still think the long-term positives are clear, and until proven otherwise, the long-term trend, bullish trend, is in place.
Okay, Shiraz, what do you see going on here near and longer term?
I think I agree with Steve's assessment. There are a number of positives out there too. I'm not entirely in the bearish camp. Earnings are very good. Interest rates are still supportive. And if the trend that we are seeing in the labor market holds, then it could help us offset some of these negative readings that we have been seeing. So yes, choppiness during the summer months because this debate between the bearish and the bullish views kind of plays out. Longer term, the picture looks good.
Okay, Kevin, Dow 13.1 still intact?
Still intact. For support levels, I see the near-term support, 12,378. That's the low that we saw from last week. Long-term support is 12,000, but I still see 13.1. And there's no reason why it has to stop there if it gets there.
All right, give us your top stock pick.
Mine is Central Garden. Central Garden, a pet company, ticker CENT. They do garden products and pet stuff. They have double-digit projected growth rates. They just produced a 10% positive EPS surprise, 6% positive sales surprise. My price target is $12.70. That is a 25% increase from here. If you look at a chart, it looks like they are getting ready to break out, and I think it's going to happen very, very soon.
Shiraz.
The Williams companies, an integrated natural gas producer. They have awesome exploration and production assets, a very strong pipeline, literally pipelines of natural gas distribution assets. They are splitting into two, a focused E&P player and a focused pipeline player. They are paying 2.5%, 3% yield. You're getting two for the price of one, an excellent pick.
A two for Steve.
Okay. Ryder System, which is a truck leasing and logistics company. Transportation is definitely a mid to late cycle play, and I believe that's where we are in economic expansion, kind of hitting the middle innings here, and as we move on. The earnings growth outlook is fantastic, also pays a 2% dividend. I think it easily has 20 to 30% upside potential over the next 6 to 12 months.
All right, what's on your radar for the week ahead?
It's going to be durable goods, given how poorly some of these recent manufacturing reports have been. Jobless claims and GDP revision, which comes on Thursday. So that's three things to look out for.
All right, we hope you'll join us that next time around for talk on those and other things here at the Roundtable and on Profit from the Pros. Hope the week ahead is profitable.